Good morning, ladies and gentlemen. And in my speech today, I will discuss the relationship between government deficits and interest rates. I'm sure that for those of you who are somewhat familiar with economics, you are probably familiar with both terms already. On the one hand, we have the government deficit, which describes the scenario where a government's budget exceeds the total amount of tax revenue that it collects, the income for the government. So, for example, the United States, which is the largest economy in the world, probably also has the world's largest government deficit. It's at 1.7 trillion US dollars in 2023. But what about the relationship between government deficits and interest rates? Conventional wisdom suggests that there is usually a positive correlation between the two, meaning that larger deficits would typically lead to higher interest rates. And this view is based on the idea that when the government has to borrow money from the market or from somebody, it drives up the overall demand for money, or the demand for credit, as it's usually called, in the financial markets. And Economics 101 tells us that if the demand for something goes up, its price tends to go up. And what is the price for money or credit? The price for money is interest rate. So that's why the conventional wisdom is that higher government deficits usually means higher interest rate in that country, at least. But in reality, how things play out sometimes doesn't quite line up with that thinking, because there are two things to consider, two more things. One is the central bank, because the central bank, for example, the Federal Reserve, which is the central bank of the United States, could actually roll out monetary policies to suppress the interest rate from going up. It literally just caps the interest rate at a low level when it wants to. Why does it do so? Well, usually to stimulate the economy when there is already a high deficit. For example, when there is a possible economic downturn, the Fed will act by lowering interest rate, or at least keeping it low, so that people continue to spend and to expand their businesses and so on and so forth. So that's one possible force that's kind of working against that conventional wisdom. And then another factor here is international capital flows, because the model was basically assuming a closed market where there is finite supply, and when the demand for money goes up, the price goes up. But what if there are foreign actors or foreign lenders that are willing to lend to the US government at a relatively low interest rate? Well, that kind of tips the balance again. And historically, these foreign lenders have played a pretty significant part in shaping this supply-demand dynamic in the US, thereby exerting an indirect influence on the interest rate, at least in the US. As of October 2023, Japan holds about 1.1 trillion US dollars worth of treasury securities, which is the highest of all nations, with China being number two at around 770 billion US dollars. And then we have other major holders of US Treasury bonds, which include the UK, Luxembourg, Belgium, and so on and so forth. So there were periods in time where there was a large government deficit, but it didn't quite lead to higher interest rate. For example, you may recall that during the years after the 2008 financial crisis, the US government was actually running pretty large deficits, because the government had to spend a huge chunk of money bailing out the big banks and even automakers in the US, as you may recall, if you're old enough to recall that. But we also remember that during those years, interest rate was actually kept pretty low. And that's precisely because the Federal Reserve had policies to keep interest rates low. In fact, interest rate at one point was already below zero, which was a policy that you may know as quantitative easing or QE, and also because of foreign lending, because other governments such as Japan and China were willing to lend money to the US government at the time. So perhaps we can say that real life scenarios are usually more complex than what economics textbooks would tell us anyway. And this reminds me of an old joke about economics. And the joke goes like this. How many economists does it take to change a light bulb? The answer is 8. It takes 7 economists to hold everything constant, and it takes 1 to screw in the light bulb.